The process of evaluating an IPO is no different from that of a secondary listed stock. And in this process, the prospectus is your best friend. However, if you look at the size of the IPO document, you can get a little bit intimidated. But don't worry, in this short video, we are going to lay bare the entire process of analyzing an IPO by considering the 5 top factors you must look at while investing in IPOs. Hi, I'm Vinit Bolinjkar and my friends call me VB, and welcome to the Great Indian IPO Show. So what are the top 5 factors to consider while investing in IPOs? The topmost factor to consider while analyzing an IPO is the promoter and the leadership team. Obviously, the people behind the business are the ones who will take it forward, and hence having a top-notch promoter and leadership team in place is the most vital ingredient of a successful business. And when we are analyzing this, we should keep 4 things in mind. 1, there should be no legal cases against the promoter or the leadership team. 2, there should be no related party transactions. 3, the promoter's balance sheet should not be overly leveraged. And 4 is the fact that the remuneration should not be above industry standards. These are the 4 red flags that we need to keep in mind while assessing the quality of the promoters. Additionally, we need to undertake a scuttlebutt with the dealers, suppliers and distributors, check with the local people and with their bankers to find out about the promoter's reputation and goodwill. This will go a long way in getting comfort of investing in a business with new promoters at the helm. The second factor to consider while evaluating an IPO is the sector in which the company operates. And obviously, a company will be impacted by the fortunes of the sector that it is operating in. And hence, we need to understand the demand-supply dynamics, the pricing trends of the input and output raw material. Third is the government regulations impacting the business. Fourth is the environmental issues which have become of serious concern these days. And finally is all the disruptive forces coming in from adjacent industries that the company caters to. Next, we need to analyze the business prospects of the company. Here we look at the products and services that the company is offering, the strategy, the business modes that it has, and the historical operations of the company. When we are doing the historical financial analysis, the focus should be on growth and profitability, efficiency of operations, capital structure with a focus on debt and working capital, and finally the allocation of capital and the kind of returns that it is generating for the business. Important factor to consider while analyzing the historical financial performance is that there should be no cooking up of the books or window dressing of any sort. What do I mean by that? One is you should look to see that there is no sudden marked improvement in the financial numbers, which suggests that the business is looking far better than it actually is. Another vital factor which is a necessary ingredient is that the business should have superior returns historically, because historical superior returns clearly indicate that the business prospects going forth are expected to be much better. So let's come to the meat of the issue: capital raising, issue pricing and valuation. First thing to consider is, why is the promoter raising money? Is it to lower debt or improve working capital, for business expansion or diversification? When we are looking at this, we need to see whether the diversification or expansion is related or an unrelated diversification. If the diversification is unrelated, then it is a risky proposition and then it raises red flags. And the third thing to consider is whether he is doing it for M&A purposes or to buy out certain businesses. Now, whenever a promoter is raising funds, he is obviously diluting his equity, isn't it? In this case, we should ensure that the equity of the promoter post issue does not fall below 30%, because the street views it very negatively considering the fact that the promoter has very low skin in the game. Now, when the promoter is raising money and the shareholder is ready to invest in the company, two factors obviously come into play: pricing of the issue and at what valuation is the money being raised. When looking at pricing and valuation, we need to keep two things in mind. Number one, is the company a marginal player? And two, is it asking for a valuation which is far higher than peers? Because if both these factors are true, then you can be pretty sure that you are buying an overvalued stock. Also check if the issue is an initial public offering, IPO, or an offer for sale, OFS. Because if it is an IPO, the money is coming into the company, and if it is an OFS, the money is going into the pockets of the existing promoter or the investor who is offloading his shares. In case it is an OFS offering, three things should be primarily looked at: why the promoter or investor is selling, at what valuation are the shares being offered, are they more expensive than peers, and the prospects of the business going forward. Having satisfied yourself that the IPO is worth investing in, the next step that we need to consider are the IPO dynamics. So when we talk of IPO dynamics, what do we mean? 1. Participation of quality anchor investors. 2. Subscription rate. 3. What the brokerage notes have to say. 4. What are the market sentiments prevailing at the time of the IPO. And 5th, obviously, what the Great Indian IPO Show has to say about that particular issue in consideration. Cause we are here to take care of your financial interests. So that's all from our side for the day. And don't forget to subscribe to the Great Indian IPO Show.